Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So once he became a client, he says to me, I knew that this could be done, Andrew. I just couldn't find anybody do it. Everybody out there couldn't tell me how to live off my interest rather than living off my principal. I am so glad to catch up with you and be able to understand how to live on my dividends and how I can get the dividends I need to live in retirement. I'm Andrew Agemy.
And I'm Daniel Agemy, and we have a very special show today for you. And it is called the Getting Paid to Retire. In AAA, that should be everybody's goal, I would say, is when you retire, you get paid to retire, right? That's the whole point. Yeah. You no longer go to work to collect a paycheck, but you get paid. Now your assets pay you. And yeah, so tell us more about this investor who knew, this retiree who knew conceptually it was possible to get paid in retirement, but was really struggling to understand how to do it.
Yeah, well, it was really something because, I went through everything and how he could get the dividends and live off the dividends. And he said, I've been talking to a lot of people and nobody, no professional, I talked to those name brand, the ones that bring Wall Street to Main Street people, and none of them could tell me how I could live off of my dividends in a way that I can actually afford. He didn't have $10 million. So he had to make every dividend, every penny count as far as his dividends go. And so when we set him up in a portfolio that was going to generate that, he was thrilled. And it brought him a lot of peace to his mind. And that's what we're going to talk today about, right? How you can do it. And, as I've heard recently, the trust fund baby's mantra is don't live off the principal. Live off the dividends, live off the interest, right? Because you want the principal to be able to pass on to the next generation within a trust fund, right? And that's what many people did.
That's really important. I'd like to highlight what you just said there again. You live off the interest, not the principal. And essentially that turns it into a renewable asset. It can never run out if you do that. It can pass from generation to generation. And that's why the trust fund kids or the people who put the trust together, probably thinking that and passing that wisdom on, and it passes on. Because think about that. You can never run out of money from generation to generation if you don't spend the principal and you just live off of the income. And that's exactly what we're talking about today.
Exactly. Yes, indeed. And, it's something that people don't think about. And I'm excited. I know we're going to be talking about it, but I'm excited what we're going to be talking about later on in the show, how, the traditional, today's traditional approach to retirement, receiving money in retirement compared to the old-fashioned, tried and true way, which is what we're talking about, is living off of dividends. So I'm excited as we go today.
Yeah. So the traditional approach, what most people think when they think of retiring is they think, if I have $1 million or whatever number you want that to be, I'm going to take that out of the account and I will spend that money. And if I want to spend $100,000 a year, basically that money will last 10 years. That's typically how people think about it. Other people think, well, look at what my portfolio has done the last 40 years, and that will just continue on. And so I'll never run out of money. And that's the traditional way of thinking about it. If you got $1 million, you take $50,000 a year out and you last 20 years. Right?
Yeah.
If you make some money on it, great. That's how people tend to think about it. Am I getting that right, AAA? Is that what you see?
Exactly. But the problem with that is if you're 65 and you say, okay, I'm going to do that for the next 20 years, and then when you're 85 and you run out of money when you're 86, because then for a 65-year-old to live into their 90s or even 100 years old is a significantly high possibility of reaching an older age like that these days. And if you planned just to withdraw money, well, you have a huge problem.
Yeah,
But
sequence of returns or when you retire has a big thing to play with in with that as well, AAA, because that $1 million could drop, like it's nothing for these markets to go down 20%. Right now, some people might say, well, it goes right back up. But this is where it's so much different when you retire than when you're saving, because if it goes down 20% and your $1 million turns into $800,000, and you still need that $50,000, the percentage of your assets you're drawing each year just went up huge, because now you're taking $500,000 out of $800,000 and you're selling your principal, you're selling your assets to get that $50,000. Now, when it goes back up, you won't go back up to $1 million because you were forced to sell while markets were down. Now, that's a 20% example, which we see, it feels like every couple of years we see at least a 20% drawdown, right, AAA? But there's been times where we've had 50% drawdowns, right? 40% drawdowns. And that could be devastating to the portfolio. So when you talk about selling shares or selling assets in order to get your draw, in order to get your retirement income, that's not you being paid. That's just you selling principal and taking assets out of your account.
And the problem with that is you could run out of money, and that's retirees' greatest fear, is running out of money before they run out of life. If you just joined us, you're listening to the Financial Strategies with Andrew and Daniel Agemy. Today's topic is getting paid to retire. Dividends, bonds, and the income that you deserve. Well, we're excited to come to you today, and we have a paper that we'd love to be able to give you that will help you understand this stuff a little bit better, and that you can read up on, because people don't know what people don't know. It's called An Introduction to Stock Dividend Investing. This paper will give you what you need to know when you don't know how the dividends work, how you can reinvest the dividends when you're working, and then when you go to retire, you can have the dividends come to you. So we'd love to put this paper in your hand for free by calling us at 800-725-7616 for your free copy. 800-725-7616 for your free copy of Stock Dividend Investing. You listen to Financial Strategies with Andrew Daniel Agemy, this father-son team coming to you because people don't know what people don't know. Daniel, I am so glad we're going over this, because people have, so many people, and I'm convinced, have no clue what dividends are or how they can work for them. And, like you said earlier, when you retire, you don't have to go to work anymore for your paycheck, but you should be getting paid. And basically your money is literally working with dividends. Your money's literally working for you and creating a paycheck. And I remember the one client that we had that he loved this concept, and he was like, 6 months or a year before retirement. And he says, I want to see how this actually works, Andrew and Daniel. And he says, let me start getting those dividends in my checking account. So we turned it on so that he could get the dividends in his checking account. And he's been retired, something like 16 years, I think, at this, or actually probably more like 18 years or something at this point, somewhere in that vicinity. And it's just loving it, and still continuing to work and provide for him without digging into his principal. So it's a beautiful thing.
Just let those dividends come in. Yeah, AAA. So that's the second approach, right? So we talked about the traditional approach, which most financial professional, most investors are doing. And that's you've got that pile and you're just drawing. And it's really dangerous. It's really freaky when markets come down. And that's why a lot of our clients, when they're new and they become clients, they will check their portfolios because that's what they're used to, what matters. And I talked to a client the other day who, before we met him, he had a lot of variable annuities, and he was just disgusted when he came to us because he had these things for so long and they went up and down and the fees were tremendous. He never made any money. It was disgusting. He is absolutely disgusted. And so he was logging in, checking the values. And he told me the other day, he's been a client for just about a year now. He said, I stopped logging in and looking at the values because it doesn't matter. It doesn't matter. We went over how much income he had, and he saw the income coming in, and he saw he was taking the income, but the account was still going up. The account went up a lot, even though in his situation, he was taking dividends. He was just watching the dividends come in, and he said, I gave up even logging in because it doesn't matter. Yeah, and that's the second approach, right? AAA, that's the second approach. You have the same $1 million, you take $50,000 out a year. The difference is when you have a 20% drawdown, like we said in the first scenario, guess what happens? The 50's still coming in. Nothing changed. It didn't matter that it went to 800. You're not selling a single share. You're getting paid to retire. How beautiful is that? Right?
Yeah,
You're getting paid to retire.
Exactly. And that reminded me of another client that, they said to me, hey, Andrew, I want to figure out how to log into Charles Schwab. You guys use Charles Schwab to hold your money and do your trading for you. I want to log in. I said, and they were having the hardest time logging in, and it was causing like all kinds of issues in the office because they wanted to know it and they were upset. And I get it, right? It's all their money. They want to log in. And so I finally said, why do you want to log in this Charles Schwab? Because we want to see what the market is doing to our accounts every day. And I said, you know what? Your money's not in the market. You don't have to look at it. And so that was so freeing to them, because we provide them the documents and the summary of their account so that they can see what's going on. You don't have to worry about it every day, what's happening. It's just plodding along. The slow, steady wins the race kind of thing. And so when they found that out, they were really thrilled. And we were thrilled because they didn't need to get their login. It wasn't going to do what they wanted it to do. They didn't have to keep checking their accounts. So it's a beautiful, the other way, the traditional approach is what we call engineering income. It's not really income. It's just engineering income. You're just creating an income, but it's really just using your principal. And as long as the stock market's going up, that works well.
It works. Yeah.
But unfortunately, the stock market goes three directions: up, down, and sideways. And a lot of people in our listening audience, I don't think, understand how the market has the past 6 months basically been going sideways. It's been going up and down, but it's basically sideways for the past 6 months, generally speaking, the S&P 500. And that the good news is with dividends, that's volatility. So it works well for you. When it goes down, you buy more shares. When it goes up, it makes your values go up when you're using the dividend approach. So it's a different way to look at things.
It's the markets spend about 40% of the time not going up. And so if people want to think about it like that, if you're relying on markets to go up, that means 40% of the time your portfolio is not creating any income. It's not creating any growth. And so do you want 40% of your retirement not to have any income? Do you want not to be able to collect any money from your retirement? Do you want to not get paid for 40% of the time? That's what people really have to think about it. And that might not sound like a long time 40% if you're young and you're saving money.
Right.
But not getting paid for 40% of your retirement is a pretty brutal and unacceptable outcome.
Right. And that's exactly what happened to people because they weren't prepared for that when 2008 happened or in the financial crisis. And that's why they couldn't retire or had to go back to work because they weren't investing for dividends. They were investing for capital appreciation, essentially pure growth with share price growing without dividends. And that is very problematic. Well, if you just joined us, we're listening to Financial Strategies with Andrew Daniel Agemy, and today's topic is getting paid to retire and using dividends and bonds and income that you deserve, getting the income that you deserve. Well, are you ready to retire? Well, we have a checklist to put together for you that we'd love to put in your hands for free to be able to take a look and just go down the checklist, find out, do you have the income that you need? How about your Social Security, the health care, the tax efficiency, investment allocations? Are those right? How about your estate planning? All these different things that you need to look at when it comes to retirement planning. We love to put this retirement readiness checklist in your hand for free by calling us at 800-725-7616, 800-725-7616 for your free copy of the Retirement Readiness Checklist. Ask for it by name, the Retirement Readiness Checklist. Call now.
Financial Strategy with Andrew and Daniel Agemy.
I love getting paid to retire with dividends. What I think it's like is you're investing in chickens. And the beautiful things about chickens is if you need to eat in retirement, you'll always eat if you only eat the eggs. It's a renewable resource. And as long as you just take the eggs and you don't kill any chickens, you'll always eat. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about getting paid in retirement, dividends, bonds, and the income you deserve. AAA, people deserve, they worked hard, and they deserve to retire in a way where they get paid. They get paid when markets are good, they get paid when markets are bad, and they get paid when markets are flat. That's the way that it used to be done years ago when people had pensions, right? It didn't matter if markets were going up or down or sideways. You got your lifetime income, and the investments, the managers of the money, the institutional managers manage the money in a way where they would be able to keep the promises they made to the retirees, right?
Yeah.
And that's all we're talking about. That same type of investing is where you're getting paid no matter what's going on.
It's a beautiful thing. And, it's also what people did in the 50s, 60s, and 70s when they, with their other savings, right? Because most people back in the day didn't have retirement savings. It wasn't until, the 80s really that 401ks really became popular and people started saving in for their retirement and 401ks. And prior to that, there really wasn't any savings, but people saved money and then they would invest it in stocks, dividend paying stocks that would pay them dividends. Or if they were conservative and afraid of the stock market, they put the money in banks and get CDs and get the interest from CDs. And they would only use the interest and or the dividends depending on how they were invested, and they always kept the principal. And that is a beautiful thing. And why would they do that? Well, the most beautiful thing about dividends and interest is compounding. Compounding, the eighth wonder of the world, as it's been said. And compounding is one of the things that I realized recently was it's not just one-dimensional growth, and it's not just two-dimensional growth, but it's really three-dimensional growth, which is really a cool thing that you get compounding in multiple ways. So, the simple way that I would describe that before I let you tell us, Daniel, is like in the example of the chickens and the eggs. Chickens lay the eggs. If you don't need the eggs or all the eggs to eat, well, we take the leftover ones and we buy more chickens. And now when we buy more chickens, what do we get? We get more eggs. So $100,000, if it's getting 5%, it turns into $105,000. Well, the next year you get 5% on $105,000. So maybe you make, instead of $5,000, you maybe make $5,500. And then it keeps doing that every year. And eventually your $100,000 becomes $160,000, $170,000, pumping out $6,000 or $7,000 a year of interest and dividends. That's compounding. And then that's how it's the third dimensional, because you're compounding upon the compounding, which is a beautiful thing.
Yeah. So what is a dividend? What is a dividend? A dividend is a portion of a company's profits. So you buy a company that has awesome profits, and they say they're typically large companies, well-established companies, and they want to reward their investors. Or if it's a bond, it's because the company's growing. Maybe they're building a plant, they're expanding the business, and so they need money. And so you can participate in that plant expansion by lending the company money, and they promise that they will give you back, or they give you a contract that says they will give you back your money, when they'll give you back the money, and how much they'll pay. So it's basically, it's a portion of the profits. If you think about like a tech firm, a startup, they take all their growth, they take all their profits, and they reinvest it into the company, and they try to grow the company. And now sometimes those things blow up and they don't make it. Sometimes they turn into Facebook or Amazon. And so what you take on, the risk you take on there is that you got the right company, and that they'll be able to manage through each cycle. When you buy one of these larger established companies that's paying dividends, then you sit back and you collect your piece of the profits as a partial owner, and you can do whatever you want with that dividend. You reinvest it, and as your example showed, AAA, the dividends typically grow in two ways, right? They grow because typically these large companies are increasing the dividend payout. They're increasing the dividend each year. And then if you're compounding it, you're getting more shares. You're buying more shares, which is paying you more dividends. And then they're increasing the dividend, and then you're buying more shares, which is buying more dividend, or creating more dividends, which is buying more shares. And that goes on forever until you decide, hey, it's time to retire. And now you start taking those dividends instead of letting them compound. A way you could think about it, it's like a snowball, right? AAA. If you're not going to use the chicken and egg analogy, you could think about it as a snowball. It takes a while to get rolling, but once that thing starts rolling down the hill and it's just big, it knocks trees out of the way. It knocks whatever it's got to do out of the way as it rolls down the hill faster and bigger and bigger.
Exactly. And that's a beautiful illustration of that. I love it. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is getting paid to retire. Isn't that a beautiful thought? Well, we have for you today, as this father-son team, coming to you to help you educate you with what you may not know, what you don't even know when it comes to retirement. And we have a book that will teach you more about this dividend approach with bonds and income that you deserve. Common Sense Income Strategies, written by our friend Mike Lee, some CPA and PFS, to be able to help you be able to understand this in a simple fashion. It's easy to read book that we love to put in your hand, because he goes through how you can use this in your portfolio to help you. Now, it's not necessarily a thing to try that, don't try this at home, but at least be able to understand how it works, because you're not going to get this from Kramer or from some of those other shows on TV when it comes to educating on dividends. And so we love to put this in your hand for free. The next 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy of Common Sense Income Strategies. Call now. Daniel, as we're looking at and understanding getting paid to retire and the compounding factor, and we use the analogy of chicken laying eggs, we use the analogy of a snowball getting bigger as it's rolling down the hill, right? All these are good analogies for what happens with dividends. But why do dividends matter for retirees? Bring it down to that. That's the whole show, right? It's getting paid to retire with dividends. Well,
AAA, they matter because you want to get paid in retirement, right?
Right.
And as you illustrated before, the compounding effect of dividends, the compounding effect can be incredible. And so you don't necessarily need markets to do well for your dividends to compound. And that trips people up a lot of times, because just because the portfolio, say we went through another period like it was between 2000 and 2013. Basically, the market did nothing. It did a lot. It crashed 50%, and then it got back to even, and it crashed 55, 60%, and then got back up to even. But if you, let's say, had $1 million in S&P, you'd have the same amount of money. You'd have $1 million 13 years later. Now, I don't know about you guys listening, but our clients would say that's unacceptable. That's not worth it. And that's assuming you didn't freak out and sell in either of those crashes, which most people, not everyone, because we know plenty of people who didn't sell through those, but most people, I mean, you had people knocking down your door, AAA, in 2009 and 10.
Right. Exactly.
Saying, get me out of here. I don't care how much that I'm losing. But the point with the dividends is it doesn't matter if you're going through those cycles. The dividends compound. And again, they can compound from two ways. They can compound because now the stock is lower, and so you're buying more shares because the dividend is buying more shares of that company because the stock is lower. And then two, when you pick the right companies, they increase their dividends. And so in a 10-year period, the market might not do anything, but your yield on cost could be 3%, and 10 years later, it could be 6%, even though the market didn't do anything. And that is really why dividends matter so much to retirees.
Yeah.
You don't have to sell a single share to get paid in retirement. The other thing is dividends are qualified. Dividends typically are taxed. And so a lot of our clients, they don't pay any tax. It depends on your tax bracket.
Right.
A lot of our clients don't pay taxes on the dividends that come in. Now, there's all kinds of tax qualifications. This isn't an IRA, a non-qualified type show. So it depends what type of account it's in. But dividends can be a very tax efficient way to get retirement income or to get paid in retirement.
Right. The taxation can be huge. In my mind, one of the biggest reasons why why it matters for retirees to use dividends is because they keep paying. And just like that chicken, as long as you own that chicken, they keep laying the eggs, right? So it doesn't matter if the chicken gets skinnier or gets fatter, they keep laying eggs. And that's the beautiful thing. And that's what can keep somebody retired even through down markets, because they keep paying eggs. Or they keep paying dividends, and they keep paying. So that's a beautiful thing. And that's where you have to, again, you don't try this at home, because some companies, during COVID, there were over 100 companies that stopped their dividend.
Yeah.
But there were other companies that never stop and won't stop, because if they do stop, it's going to be like the kiss of death to the company. So they're not going to do that for fear that it might hurt the company. So it's a much more secure approach.
And there's all different layers, AAA, to the dividends. You can do common stocks that pay dividends. You can do preferred stocks. You can do bonds, and we'll get into that stuff as we go here. But it depends on you. It depends on the retiree listening. Do you want more certainty, or do you want more upside potential? And you can pick in the spectrum of where you want it, or it can be a balance of some, or you have contracts on some, and you've got they're going to be increasing the dividend every year, you think, on others, right? There's a complete spectrum, and people get to choose where they want. And that's part of the exciting part. There's a bunch of different things in that universe of income generating alternatives.
Exactly. And if you have a very good, well diversified portfolio, something's always going to be doing well. Something might not be doing so well. So the whole thing about investing is buy low, sell high. So you can sell from what is doing well and buy that which is going low, so that when what is low goes back up, it will compound or it will grow dramatically. So it's a beautiful thing. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is getting paid to retire. Who doesn't want to get paid to retire, right? That's the whole point, is stop working for your paycheck and let your money work for you. Well, we have a paper that we'd love to put in your hand to help you understand these things a little bit more, called Beware of Mutual Fund Risks in Retirement. A lot of people invest in mutual funds and they think they're going to be good for retirement. Well, this paper will help educate you to recognize and to be able to not put your head in the sand, forgetting about risk, but looking seriously to see what is the risk, so that you can recognize if the reward is worth it. So we'd love to put this in your hand for free by calling us at 800-725-7616 for your free copy, 800-725-7616. Beware of mutual fund risks in retirement. Okay, yours for free. Call now.
Time for some tough questions for these financial advisors. What makes Retirement Income Source different from other financial?
Our extensive experience generating investment income quickly, so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love. We gotta talk to these guys. We're done here.
This is Financial Strategies with Andrew and Daniel Agemy.
Getting paid to retire. Dividends, bonds, and income that you deserve is a beautiful thing. If you have $500,000 and you're getting $25,000 or $30,000 a year of income, it's certainly plausible that in 10 years you could be getting $50,000 to $75,000 worth of dividends. Or if you have $1 million and you're getting $50,000 to $60,000 a year of dividends, within 10 years, that could possibly be $120,000 to $150,000 of dividends is plausible. I'm Andrew Agemy.
And I'm Daniel Agemy. You're listening to Financial Strategies. Today we're talking about getting paid to retire. And AAA dividends are it's such an incredible thing. Stock dividends are pretty cool, but there's other types of dividends and interest that people can earn if they're not, we meet a lot of people who are not interested in being in the stock market. You told a story earlier about somebody and they didn't want to be in the stock market, and you told them you're in the bond market, you're in the income market, which is different. So there's a whole universe of other things besides dividend stocks. Yeah. Most people know about dividend stocks. Most people, when we say we're income specialists, when we say we help people retire and live off of their income, typically somebody will always say, my mom or my aunt has dividend stocks and she lives off of those. But there's a lot of other things that pay dividends that most people don't know about. What are some of those things, AAA? Why would people be interested in some of these non-stock market type income investments?
Well, in my mind, one of the biggest reasons being invested in some of these other non-stock market ones is because the dividend is more sure because it's a contract. And you know what the dividend is going to be. It's typically set at issue and doesn't necessarily fluctuate the way that a stock dividend could change. A stock dividend can be started, stopped, increased, decreased every quarter. So you never know what it's going to do. So if you're really dependent upon your money, the more secure contract approach is a better way of doing that. And there are several things that are contract related. And what I do is, I try to help people understand this concept of contracts by, when somebody gets a mortgage, the bank is loaning them money through a contract based upon their credit rating and credit score and such. And the bank knows how much they're going to get back because the contract says you're going to pay the bank back this much money, and by this point in time, you will at least, no later than this date, you're going to pay them back all your money. So they know what to get. And if for whatever reason you renege on your obligation, they're going to take your equity. They're going to ruin your credit. So if you're going to not pay a bill, it certainly isn't your mortgage. And why? Because that contract is kind of holding your feet to the fire. So isn't it a beautiful thing? If you can loan money, instead of the bank loaning you money, you loan money to other companies that by contract, they're going to pay you a certain amount of money, certain amount of interest, a certain amount of dividends over a period of time. And then at the end, you get your money back.
So you're talking about corporate bonds, AAA, and corporate bonds, they've got two guarantees. And people get caught up on this all the time because what people typically do is they say, I don't know how to buy corporate bonds. They're difficult. You got to buy them on the over-the-counter market. Like advisors and individual investors really have a difficult time with corporate bonds. So what do? They go and they buy a bond fund.
Right.
That can be problematic. It seems good because you're getting income and it feels like you're getting paid. But why did we switch from stock dividends to corporate bond dividends? Well, because of the two guarantees. You don't have the two guarantees with a stock dividend that you have with a bond dividend. The corporation or the government will give you two guarantees. The first guarantee is they tell you exactly how much you're going to get paid. We're going to give you 6%. You get 3% in the first 6 months of the year. You get 3% in the second 6 months of the year. And they tell you exactly when they're going to buy that back from you. So in 5 years, you're going to get it back. So if you bought a $100,000 U.S. bond, 6%, they will give you $6,000, $3,000 in the first 6 months, $3,000 in the second 6 months. And then at the end of 5 years, you get your $100,000 back. It doesn't matter if the bond goes up to $110,000 of value, although you could sell it there. And it doesn't matter if it goes down to $90,000 in that time frame. You collect your $6,000 each year for 5 years. And at the end of the 5 years, you get your $100,000 back. As soon as you put that into an ETF or a mutual fund wrapper, and there's a fund manager buying bonds inside of this, you give up those two guarantees. And then you might as well just go own stocks that pay dividends.
Right.
You might as well go buy something else that pays dividends, because you don't have the two guarantees that you buy a bond for. And bonds typically pay a lesser dividend than preferred stocks or even a lot of common stocks, because those two guarantees. So if you give up the guarantees, you're getting paid less without the guarantees. That doesn't make any sense.
Right.
And you have to pay a portfolio manager a fee inside of that to buy the bonds for you. So you're giving up your two guarantees. You're paying somebody to buy and sell bonds, not on your behalf, but on behalf of all the investors, which means if somebody else gets panicked and sells the bonds, they're selling your bonds instead of you using the contracts that the bonds are used for. So those don't make a lot of sense in my mind, those bond mutual funds or bond ETFs, because you give up the guarantees, and that's why you would buy a bond in the first place.
Yes, that's right. And you're listening to Financial Strategies, and you're Daniel Agemy. Going along with what Daniel's saying, we have a paper we'd love to put in your hand today called Beware of Mutual Fund Risks in Retirement. There are risks that you may not be aware of. People say, invest in mutual funds because they're not as risky as other things. Well, but they do have risk. And the question is, they may not be as risky as other things, but they may be more risky, especially if you're investing in bond mutual funds. Bond mutual funds are more risky than individual bonds, at least if you know if you have somebody trading the bonds for you and working those for you, buying and selling. So we love to put this in your hand. Beware of mutual fund risks in retirement. Yours for free by calling us at 800-725-7616, 800-725-7616 for your free copy of Beware of Mutual Fund Risks in Retirement. 800-725-7616. You're listening to Financial Strategies. This father and son team coming to you to be able to help you know what you don't know. Today, we're talking about getting paid to retire. Daniel, that was a great illustration in regard to how those corporate bonds work, and the two guarantees of the interest rate is guaranteed for the length of the bond, kind of like on a CD, but also that you're guaranteed with an individual bond to get your money back. And that's why they say, when they talk about diversification, is that bonds are safer compared to stocks. Bond funds are not, but individual bonds are. So that was a great analogy there, and great rendition there of how those things work. Anything else on it? Or, one of the things that didn't really bring out there was the aspect of it's like having rental property where the tenant is contractually obligated to pay you rent every month. And you get the rent every month, and then at some point in the future, at the end of the lease, they buy the property from you at a preset agreed upon price. So you get all this money all along, and then you get to sell the property, at the end at a preset price and get your money back and can go do something else again. So that's a beautiful thing. Yeah. What else?
Yeah.
Or you got more than that, or you got other things?
These things, a lot of people will worry about interest rate risk, especially the past few years. And you can get bonds that mature at any time. You can get 1-year bonds, you can get 2-year bonds. So if you're buying shorter maturity bonds, it really eliminates the interest rate risk, at least for rising rates. You still have reinvestment risk, right? If rates got cut, what would you do? But that's one of the cool things, is you can stagger them, and you can build the bond ladders in a way where you can protect yourself from rising rates or lowering rates and still get good income throughout the whole lifetime of those bonds. Another one that people really like are these preferred stocks, AAA. And these are kind of a hybrid between a bond and a stock. They trade on a stock exchange like a stock, but they pay dividends like a bond, where when the preferred stock is issued, it has a coupon printed right there on the stock certificate. and it says, we're going to pay you 6% or 7%. And they pay quarterly, which people like, instead of paying twice a year. And so with the preferred stocks, a lot of times these are qualified dividends as well. And so with the preferred stocks, you can sit back, you can collect these dividends, and a lot of times you can get really strong companies that pay nice dividends. And so the preferred stocks are something that we have liked, especially as rates have gone up, because now you can buy these things and they have much less volatility than stocks. But if rates are lower in the future, you'll get price appreciation on top of your dividends. And so these are kind of a nice, neat thing where you can take advantage of future rates being lower, and you can hedge that against kind of maybe your bonds and things like that. So it's really a neat thing that you can put in the portfolio to give you some big income, and you can use them in a way to hedge interest rate volatility.
Nice. Yeah. Who doesn't like hybrids? They have the best of both worlds, right? I mean, at least for a portion of life, right? So that's a beautiful thing. I like that.
Yeah, AAA. There's also baby bonds, and they're very similar to the preferred stocks. They could pay a monthly dividend sometimes. They're not qualified dividends, but what they do is they mature within 5 years or less. So you can buy these. They typically pay big dividends, maybe somewhere between 7 and 8%. And they have those short maturities. So what I mean by maturity is, when you're getting your money back. And so the company will give you your money back in, let's say, 2028. So you buy it back 2 years from now, and you collected 7% in dividends throughout those 2 years. That's a pretty cool thing to have in the portfolio as well. And those are very similar to preferred stocks. They're a little bit different, but they're very similar to the preferred stocks.
All right. Cool. That's a great thing. And the thing about these is that buying them right at the right time, selling them at the right time. When it comes to the preferreds, we know how to buy those. So sometimes we can buy them under, at a discount when we're buying them, and let them go to a premium, sell them at a high, and wait till they fall back down and buy them at a discount again. So that, which really helps our clients pick up more compounding from that aspect. So it's a beautiful thing. So if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is getting paid to retire using dividends, bonds, and income that you deserve so that you can live the retirement that you deserve. So today we have a checklist for you that people are always asking, okay, can I retire? When can I retire? And this is called the Retirement Readiness Checklist that we love to put in your hands. That's just a simple checklist to go down and to see if you have all the boxes ready to be checked. And if not, you can certainly call us and we'd be glad to help you figure out how to get those boxes checked. 800-725-7616 for your free copy of the Retirement Readiness Checklist. 800-725-7616 for your free copy of the retirement checklist. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
A recent analysis found that retirees are increasingly prioritizing dividend income over portfolio size, because a portfolio producing $45,000 a year in annual dividends from a $900,000 base feels far more secure than a $1.1 million portfolio generating only $25,000. One requires selling, the other doesn't. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about getting paid to retire. What could be better than that? Getting paid to have a week full of Saturdays, huh, AAA?
Right, exactly. Yeah, just having that money come in, no matter what, and it can even be increasing as time goes on. To keep up with the inflation, or just maybe the needs, and desires that you have to be able to do some other things that you hadn't planned on doing in your retirement.
AAA, that analysis that was done is pretty interesting, and it doesn't surprise you because you've been saying that for years, right? It doesn't
Right.
surprise you that investors are realizing that it feels a lot better to collect income than it does to have more money that's volatile. We've spoken many times about how if you're in your early days and you're saving, you've got $100,000 and you've got a 40% drawdown. Yeah, it doesn't feel good. Your 100K went to 60, but like, what's 100K do today anyways, right?
Right.
But
Right.
when your $1 or $2 million portfolio goes down 40% and you don't have $1 million anymore, you got 600,000, that feels devastating.
Right.
And so when you're collecting income, I had this exact conversation with a client recently he wants to hit that $1 million mark because there's something to say about having $1 million. And I explained to him that it's cool to hit that $1 million mark, but don't scrimp and don't not enjoy retirement so you can get to the $1 million mark, because he has more money in income than I've seen anybody be able to generate other than, people in our sphere off of $1 million. And so I told him, you can spend this money. Don't worry about it. Spend the income. And he's saying, well, maybe I'll just let the income compound until we get to $1 million. But it doesn't matter that dollar amount so much unless it's a psychological thing than it does what you can create, what you can get paid off of that number. And that's why I find that analysis so interesting, that investors are realizing that they want to know what can come into their account. They want to know what they can get paid, not just what the 401k statement says.
Yes, exactly. And, going along with that is the idea that, dividends coming in reduces stress because, like you said, they know what they're getting paid. So it doesn't matter if they're on a cruise ship somewhere and they hear, oh, the stock market dropped 20 points, 40 points, whatever the case may be, or percent, I should say, as opposed to points, but that they don't have to worry about it because they know that they've got this income coming in, and they're still going to be able to pay this month's bills and next month's bills and whatever else, and do the things that they want to do without having to put it off because they didn't invest their monies properly.
Yeah, well, AAA, I wouldn't even say like that they can pay their bills. It's you waited how long for retirement, and like you shouldn't have to put off remodeling the house because the markets aren't cooperating. You shouldn't have to put off buying a new car because the markets aren't cooperating. You shouldn't have to cancel your vacation. And we've seen people come in and have told us about they had to do those things because the markets didn't cooperate. And to me, that's what this show is about. It's about getting paid in retirement. And when you get paid, it doesn't matter if the markets are cooperating. You should be in a spot where your portfolio is paying you and you can still go on vacation even though markets are crashing, or even though there's all the uncertainty that's going in the world today. Maybe you want to stay away from certain countries right now on your vacation, but it shouldn't be that you don't have the money because there's volatility and there's stress going on in markets.
Exactly. That shouldn't be, when you get to retirement, you want it to be less stress. What we are always saying is an educated retiree is a happy and stress-free retiree, right? Because they'll be able to make good decisions once they get the education that they need to be able to do that. So you're listening to Financial Strategies with Daniel Agemy, and today we're educating everybody on getting paid in retirement. It comes time to stop working for your paycheck and start having your money work for you and pay you. And that's what we're talking about today. We'd love to be able to educate you further. And with that, we have we want to be able to tell you that we have a conversation. Okay, so many times people talk about, hey, can I retire? When can I retire? How much do I need to retire? These kinds of things. And there's some questions that go behind that. It's not your daddy's retirement anymore kind of thing. So with that, we have to be able to look at and have a conversation about maybe you qualify for the retirement readiness report or the retirement risk report if you're in retirement. And this is something that we can have a conversation about at your leisure to be able to see what your situation is. Do you have the dividends that you need? Do you have the paycheck coming in that you need? Or do you need to change something? Well, we can talk about that. Love to be able to have that conversation with you. If you'd like to have an RRR conversation, a retirement readiness conversation, call us at 800-725-7616, 800-725-7616 for your RRR conversation. Call now. Daniel, as we continue and we're finishing up, getting paid to retire, today's title for Financial Strategies with Andrew and Daniel Agemy, I'm reminded that people should not be trying this at home when it comes to these things, because we didn't even have time for all the different dividend and bond-like pay instruments that are available to people to be able to use. But ideally, they're going to be able to use a true income specialist like you. And, what are those things that a true income specialist is focusing on and what makes them of value to people that might be in our listening audience?
Well, AAA, when we're talking about these income things, you're right. We did not get all the way through everything we wanted to talk to today about the types of investments that pay you, the types of investments that create income so you can be paid in retirement. We went through some of them, but we weren't able to get through all of them. So there's even more. And they're really pretty cool things. But the people who focus on income have special tools, right? They have special tools, not only reporting tools, so they can show their clients exactly how much income that's going to be coming in their accounts, and then show them what's projected for the year. And then as the year goes through, show them how they did compared to the projections, right? So that you as an investor understand what the projections are, and then are you beating those projections, right? So people who focus on income can do that. But it's really about how they construct the portfolios. So we talked about you need special tools to buy the individual bonds. Mm-hmm. Because, again, when you're buying an individual bonds, you're doing individual research on those companies to make sure that they're creditworthy, right? We're not giving money. We're not lending money to just somebody walking down the street that says, hey, can I borrow $100? Right? That would be foolish. Most people are not going to do that. Some people might say, I'll give you $100 because I felt called to do that. But they're not lending anybody $100 that they've found walking down the street. Same with a true income specialist. They're not just lending it to anybody asking for money. We had a bunch of blow-ups in credit, in private credit recently. And these huge investment companies invested in these companies that didn't have real cash flows. And it's like, how could these smart people invest in these bad companies? They didn't do the research. And you have to watch out for that when you're investing in funds, because they might just be saying, well, we buy enough stuff, it doesn't really matter. Or we have enough money, or it's not my money, or I don't know what they say. But why they didn't actually do the due diligence on those companies blows my mind. But that's right. When you get a true income specialist, they know how to do the individual work on the companies to check the credits. And they use special tools, like I said, for reporting back to you. And then, as we talked about earlier, getting duration right. Again, people at Silicon Valley Bank, they didn't understand duration. How these CFOs of a bank didn't understand duration. That's stuff you have to watch out for, because when you're in a low interest rate environment, long duration or long maturities are very different than when you're in a high interest rate environment, right? And you have to be careful. You have to make sure you're not just getting an investment person like the CFO at these banks that blew up because they didn't understand duration. They weren't investment. They weren't income people. They were investment people. And that's how the difference between getting an investment person or you understanding investments could be the difference between the bank blowing up or your portfolio blowing up and sitting back and collecting awesome income because you got an income person that understands the way income works.
Exactly. Good. And if you're 60 to 75 years old, a broker is not going to be able to do this for you. You don't need the next hot tip or what's gonna go through the roof next. That maybe it goes through the roof, but maybe it goes the other direction as well, right? What you should be looking for is somebody that's going to be able to create an income machine for you, to create a paycheck for you every month, every year, so that you can have more than enough income to do all the things you want to do in retirement. Now, there are people out there right now who are retired, living on dividends and interest, and they don't check the stock tickers every morning in panic. That they just check their bank account and see the money coming in. If that's the kind of person you want to be, give us a call, because people don't know what people don't know. We're glad to be able to educate you on those things that you don't know, so that you can be in the know, and that you can make an educated decision. Retire a educated retiree is a happy and stress-free retiree. Well, today you've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been getting paid to retire and using dividends, bonds, and income so that you can do what you deserve and get what you deserve for retirement. We trust and hope that you've been educated today. Avail yourselves to some of the materials that we were handing out. And before we go, we have one last thing that we like to offer you again, is the book Common Sense Income Strategies by Michael Easom. This book is a classic book as far as we're concerned. That Michael did a terrific job of helping people to understand how to be able to get paid with dividends and with income for retirement, because it's a different story than when you're growing your money for retirement. When you're in retirement, you need to do things differently, and this book will explain that more. But if you want professional help and comments and knowing if you can retire or stay retired, give us a call, 800-725-7616. If you want the book, the next 5 first-time callers at 800-725-7616 for your free copy, call now.